Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Global equity markets have had a strong start to the year. Of course, recent weeks have seen the return of weakness, but global equities are still up on a year-to-date basis. This is despite continued weakness in corporate earnings. What explains that disconnect? We'll try to answer this here, but before that, allow me to give you some context. At the time of recording this podcast, MSCI All Country World Index, the benchmark for equities, is up 4% on a year-to-date basis, while was up more than 7% for the month of January. On the contrary, consensus estimates for corporate earnings continued to decline over the past several months. For the context, IBES consensus expects earnings of MSCI All Country World Index to grow by less than 3% over the next 12 months. This number came down from 7% a year ago. Earnings downgrades by analysts continued to come through. For instance, over the past 3 months, analysts revised down their estimates for 12-month forward earnings for global corporates by circa 3%. With that brief context, let's revisit the vital question. Are corporate earnings not important? Corporate earnings are the fundamental drivers of equities and therefore are very important. Yet, the present short-term disconnect between earnings and equity performance can be explained in two diverse ways. First, markets may be putting more near-term focus on valuations, the other driver of price returns. Equity market valuations in turn have been driven by the outlook of inflation, interest rates, and recession probabilities. Given the recent developments in inflation data for January, which we discussed on our podcast last week, markets may be right to put more near-term weight on the incoming inflation data and also accordingly reprice the outlook for interest rates. Furthermore, the growth outlook has improved over the past couple of months and market valuations needed to adjust for this too. But it is always worth keeping in mind that earnings are slow-moving drivers of returns, while valuations tend to be fast-moving. The second possible explanation of the near-term disconnect between earnings and equity performance is simply that market participants are willing to look past the near-term weakness in earnings. While earnings are weakening now, markets may be sensing a pickup in corporate earnings later this year. There are green shoots here. For instance, earnings downgrade momentum is beginning to fade. And most of the earnings weakness is explained by changes in corporate net income margins that are normalizing from record high levels. In our outlook, while we see earnings growth normalizing from elevated levels, we don't see an earnings recession in our base case. To that extent, markets may be correct in terms of looking past the near-term weakness in earnings. Of course, should an economic recession materialize, earnings are likely to fall sharply. However, in case our thesis of a mid-cycle slowdown and not a recession materialize, earnings growth can accelerate in second half of 2023 as economic momentum strengthens. In a nutshell, earnings are the key fundamental driver of equity market performances, but both can disconnect in the near term while valuations take over as the primary driver. This could mean a volatile trading range for markets in the near term as they price in changing inflation and interest rate outlooks. Equally, markets may be looking past the weakness in earnings, considering that to be temporary. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adzbam.com. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.